Okay, let's unpack this. Welcome back to the deep dive. Today we are diving headfirst into one of the, more complex financial syntheses we see each quarter, the Q3 2025 earnings call for Teladoc Health. And we're really laser focused today just on the financial narrative delivered directly by the chief financial officer.
That's right. We're stripping away some of the other commentary. Our mission today is really just to extract the pure, unadulterated financial facts from the CFO's remarks. There's a lot of quantitative data here, and frankly, the CFO's prepared remarks are critical. They show us precisely where the current strategic pivot is, translating into tangible dollars.
Especially in that mental health segment, BetterHelp.
Exactly. And where the headwinds are strongest, and importantly, whether their talk about cost discipline is actually genuinely driving efficiency.
Absolutely. So our deep dive today is designed to give you, the listener, the shortcut. We're pulling out those crucial financial health metrics, the segment-by-segment performance breakdown, and really analyzing the revised full-year guidance that the CFO laid out. We need to connect those strategic dots, between the company's stated priorities and the actual financial execution.
Segment by segment, let's do it.
Okay, starting right now with the consolidated results. So leading with the macro view, the big picture, the CFO was quick to point out strong execution against their stated strategic priorities, which ultimately pushed the consolidated results to land at or actually above their guidance expectations. So overall, how did the quarter stack up against those internal goals?
Well, they absolutely hit their targets, which, in this kind of volatile market is definitely a win. Consolidated revenue clocked in at $626 million.
$626 million.
Okay, and that was safely above the midpoint of the guidance range they had set.
Yeah.
So, that's a good news headline.
But there's a crucial asterisk next to that number, isn't there? Because while they hit guidance for this quarter, the year-over-year picture tells a different story.
It does, and this is really the first major nuance we have to dissect right away. Despite hitting that internal Q3 target, consolidated revenue actually declined 2.2% compared to the third quarter of 2024.
Down 2.2% year over year.
Yeah, and for a company that's supposed to be in a high-growth sector like telehealth, any year-over-year decline in top-line revenue, well, it raises immediate strategic questions.
So what was the primary anchor pulling that consolidated number down? What did the CFO point to?
It was almost entirely driven by significant negative pressure coming from the BetterHelp segment.
Yeah.
That segment's challenges, and we'll definitely get into the details later, were severe enough to completely wipe out the growth they achieved in integrated care.
Even though integrated care grew.
Yeah, integrated care showed some modest growth, but BetterHelp's decline just swamped it. So that 2.2% overall drop, it really tells a story of, aggressive internal restructuring and some serious market volatility hitting them squarely in that direct-to-consumer mental health space.
Okay, let's talk profitability then, because this often reveals more about management effectiveness than just revenue alone. The adjusted EBITDA figure, that's the one that strips out a lot of the non-cash stuff. That came in pretty strong, right?
It did, very strong actually. Adjusted EBITDA reached $70 million for the quarter.
70 million.
Yep, and that hit the absolute high end of their guidance range. It translated into an 11.2% margin for the quarter. And the CFO was quite emphatic, saying this was a result of disciplined execution across the business.
Disciplined execution, okay.
Yeah, and that phrase, it speaks volumes about their internal cost controls and maybe their ability to adapt quickly, even when revenue isn't flowing through as strongly as they'd like.
Right. But when management emphasizes disciplined execution, the skeptical ear always wonders, how much of that is, genuine efficiency versus how much is just kicking the can down the road, maybe deferring necessary spending? That 11.2% margin looks impressive, but we need to understand what's really sustaining it.
That's exactly the right critical question to ask. And we'll see later when we dig into the integrated care segment that they did mention specific cost management measures, things like G&A reduction and even hiring deferral.
Oh,
Okay,
yeah.
so the $70 million figure confirms they are very tightly controlling their controllable costs right now. And that allows them, theoretically, to fund the strategic investments needed elsewhere, like in BetterHelp, without completely cratering profitability.
Got it. All right, before we jump into the segments, let's quickly touch on the foundation, the balance sheet. This seems to be a consistent area of strength for them, according to the CFO's remarks.
It absolutely is. It's kind of the bedrock of their entire strategic transition right now. The liquidity and cash flow metrics the CFO presented are really robust, which gives them immense flexibility. We saw free cash flow, or FCF, hit $68 million in Q3 alone.
$68 million just in Q3.
It's in Q3, and to put that into perspective, that's almost as much FCF generated in one quarter as some smaller companies might manage in an entire year. It's significant cash generation.
And the year-to-date figure paints an even stronger picture, I imagine.
Correct. Year-to-date FCS has now reached $113 million. And crucially, the CFO highlighted they ended the quarter with a massive $726 million in cash and cash equivalents.
$726 million in cash.
Yeah, and that was actually up sequentially. It represented an increase of $47 million just from Q2. That huge cash pile isn't just a safety net. The CFO explicitly noted it provides them with significant strategic optionality.
That's always a key phrase, strategic optionality. When you've got nearly $750 million sitting in cash, you're not worried about making payroll or, minor debt covenants. You're thinking bigger.
Exactly. You're thinking about acquisitions, maybe share buybacks down the line, or just comfortably managing future debt maturities without stress. That cash gives them real power, especially in the current high-interest rate environment. It helps them negotiate. It means they don't have to raise capital at a potentially disadvantaged time.
Okay, now let's dive into the noise, as you called it. That often confuses listeners looking at the headline numbers, specifically the net loss. The raw net loss per share reported was 28 cents. But here's where it gets, as the CFO laid out, really interesting, because that figure includes some significant non-cash items that kind of obscure the true operating profitability picture.
Absolutely. You really must strip out the non-cash items to understand the core performance, and the CFO walked through these. There were three major items driving that 28-cent loss. The first one was a bit of an unexpected curveball, a non-cash goodwill impairment charge.
Goodwill impairment. Okay, break that down quickly for the listener. What is goodwill and why does its impairment matter here?
Sure. So goodwill is basically an accounting asset that gets created when a company buys another company for more than the fair value of its identifiable net assets. Think of it as representing intangible value, brand recognition, expected synergies, things like that.
Okay.
When the acquired business, and often this is linked back to past acquisitions, maybe related to BetterHelp underperforms versus its expected value, the company have to write down or impair that goodwill asset on the balance sheet. It's essentially an accounting charge that acknowledges a past acquisition might not be living up to the premium price tag paid for it. It's painful, but it's non-cash.
And the CFO specifically noted this impairment charge was, 7 cents per share pre-tax?
That's right, 7 cents per share pre-tax. And crucially, this occurred after they had already issued their guidance for Q3.
So it kind of blindsided them late in the quarter.
Seems that way. It's important for listeners to see this impairment, not as a cash expense that happened in Q3, but more as an admission about the, let's say, historical value proposition of certain past acquisitions. It hits the net loss dramatically on paper, but it has zero impact on their actual cash flow or that strong $70 million adjusted EBITDA number.
Got it. So 7 cents from the goodwill impairment. What were the other two major non-cash impacts the CFO mentioned?
Second, we had the amortization of intangibles. This is the necessary spreading out of the cost of those acquired intangible assets over their useful lives. This totaled a really substantial 48 cents per share pre-tax.
48 cents just from amortization?
Yep, 48 cents. This charge is just a permanent fixture on their P&L as long as they carry these large acquired intangible assets from major past deals. It's huge.
Wow, okay. That 48 cents completely dwarfs the underlying operating loss, or rather it contributes massively to the net loss.
It really does. And third, there was the stock-based compensation expense, which the CFO pegged at 10 cents per share pre-tax for the quarter.
Stock-based comp, right. Paying employees with stock or options instead of cash.
Exactly. And while it's non-cash, it is a crucial component of operating costs, especially for technology companies trying to attract and retain talent. So if you mentally set aside these three big items, the 7-cent impairment, the massive 48-cent amortization, and the 10-cent stock comp, the core business performance, when measured by that adjusted EBITDA, actually looks extremely healthy.
Yeah.
It's just well insulated from that headline GAAP net loss figure.
This detailed breakdown of the net loss straight from the CFO's numbers is absolutely vital for you, the listener. If you only read that headline loss of 28 cents, you might panic. But once you realize that, over 60 cents of that loss is essentially non-cash accounting noise, much of it related to past M&A, while the picture of the current operating health fueled by that $70 million EBITDA looks much, much more stable.
Precisely. Context is everything with these GAAP numbers. Okay, let's pivot now, as the CFO did, to the integrated care segment, or IC. If BetterHelp is the, let's say, high-stakes gamble right now, IC is presented as the stable machine, really fueling the company's financial discipline. IC revenue reached $390 million in Q3.
$390 million. Okay, and how did that compare year over year?
It showed a 1.5% increase over the prior year period.
1.5%. Okay, not exactly explosive growth, but it does suggest stability. Were there hidden dynamics? The CFO mentioned specific headwinds or tailwinds that contributed to that relatively modest number.
Yeah, the stability is definitely hard-earned, and there were nuances. First, they actually faced a minor, sort of non-recurring headwind that made the underlying growth look a bit smaller than it perhaps was. The CFO mentioned a 55 basis point drag that's just over 0.5% due to the resolution of a prior period billing adjustment. Basically, something that happened in Q3 of 2024 gave them a little one-time benefit last year, which made this year's comparison look slightly tougher.
Ah, okay. So without that little billing anomaly from last year, the organic growth rate might have been closer to 2%?
Exactly, maybe a touch higher.
Hmm.
And the remaining growth, well, it was significantly bolstered by their targeted M&A strategy. Acquisitions were a major tailwind mentioned by the CFO.
Right, they've made a couple recently.
Yeah, the integration of Catapult, that's the diagnostic and preventative health business, and Teladoc, which runs Australia's leading virtual care clinic, the CFO stated those collectively contributed approximately 245 basis points.
So nearly 2.5% just from those acquisitions.
Correct, 2.45% added to the segment's growth just from M&A. This really shows that buying growth is currently a key driver for IC expansion, not just organic efforts.
And the international performance, specifically within IC, that seemed like a real bright spot based on the CFO's comments.
It was impressive, yeah.
Huh.
The international business showed mid-teens growth on a constant currency basis.
Constant currency meaning stripping out the impact of fluctuating exchange rates.
Exactly. It gives you a clearer picture of the underlying operational demand.
Mhm.
Mid-teens growth, that indicates very strong execution in markets outside the U.S., like Australia, where that Teladoc acquisition fits in perfectly. It validates that part of the strategy.
Okay. Beyond international, the CFO noted a crucial shift in the U.S. revenue mix within integrated care. What was that about?
Yeah, this is a really fundamental strategic shift and one that you, the listener, really need to pay close attention to. The CFO noted they're seeing solid growth in visit revenue generally, confirming that fee-for-service models now comprise over 50% of their U.S. virtual care revenues.
Over half now. Wow, what was it before?
It was up significantly from just 40% back in 2023. So they're deliberately moving their revenue dependence away from purely guaranteed subscription revenue per member per month stuff toward more transactional visit-based revenue.
What are the risk-reward implications of that shift, moving from 40% to over 50% fee-for-service? I mean, it potentially offers higher marginal profit per visit, but it also introduces volume risk, doesn't it, if utilization dips?
It's definitely a higher risk, higher reward model. Subscription revenue is predictable, it's steady. Fee-for-service, however, hinges entirely on utilization, which can be more volatile, influenced by seasonality, plan design, all sorts of things. But the upside, as you said, is that once you achieve high utilization, which their absolutely massive membership base helps guarantee the marginal costs of handling one additional visit are very low, so it can lead to highly attractive profit flow-through and margin expansion. This shift really indicates confidence in their ability to drive that high utilization among their members.
Speaking of scale, let's look at those sheer membership numbers the CFO shared, the foundation for driving that utilization.
The scale is just, well, it's staggering. U.S. integrated care membership reached 102.5 million members in Q3.
102.5 million.
Yeah, and that figure hit the absolute high end of their guidance for the quarter, representing a 9% year-over-year increase. That 100 million-plus membership base, that's the core asset. It's the captive audience they can then try to cross-sell into, with chronic care programs, mental health checkups, specialty consults, and so on.
And their ability to actually do that cross-selling, specifically with chronic care, seems to be reflected in the chronic care program enrollment metric. The CFO highlighted a key turnaround there.
Yes, this was a critical positive indicator mentioned. Chronic care program enrollment marked a very welcome return to sequential growth. That means they added members compared to Q2, which reverses some recent slightly negative trends they'd seen.
How many did they add?
They had 48,000 net new lives in Q3, bringing the total enrolled population in chronic care programs to 1.17 million. That's about a 4% sequential increase from Q2.
Okay, so halting the decline and showing sequential growth again, what's driving that?
Well, it suggests that maybe some new engagement strategies are finally starting to pay dividends, perhaps leveraging the data and diagnostics capabilities from that Catapult acquisition. It seems they're finding ways to combat the natural enrollment churn in those programs.
Yeah, a return to sequential growth in chronic care, even if modest, is probably a major psychological win for the investment community. Shows the platform isn't totally saturated yet. Now, let's assess the segment's profitability, which, again, the CFO indicated exceeded expectations.
This is really where IC shines as the cash engine for the whole company right now. IC adjusted EBITDA was $66 million.
$66 million from IC alone.
Yes, and that translated to a powerful 17% margin. 17%. Not only did this exceed the high end of their guidance range, but it confirms that the operational efficiencies the CFO keeps talking about are real and seemingly quite sticky within this segment.
What exactly fueled that margin upside? Did the CFO give specifics on where the efficiencies were found?
Yeah, they drilled into this a bit, attributing the upside to, one, that positive revenue mix flow-through we talked about from higher utilization, and two, very effective cost discipline. Financial improvements were explicitly noted in two critical spending categories: technology and development expenses, and also general and administrative, or G&A, expenses. They also mentioned, as we touched on earlier, that a hiring deferral contributed.
So it sounds like it wasn't just generic cost-cutting, but more targeted optimization of internal structures and administrative costs. That perhaps suggests a more sustained commitment to efficiency going forward.
That seems to be the message, yes. It suggests they're trying to make efficiency part of the culture, not just a temporary fix.
And that 17% margin is impressive. To put that in perspective, in the digital health world, getting to that kind of margin suggests they really are hitting scale economies. They're managing their provider costs effectively and really maximizing the leverage they get from their platform technology. It's the kind of margin profile you absolutely need if you're going to bankroll the much more volatile and currently much less profitable BetterHelp transition.
Absolutely. IC is funding the future right now.
Okay, now we move from the stable, efficient foundation of integrated care to, well, the volatile, high-stakes engine, BetterHelp. This is where the CFO acknowledged the strategic pivot is causing some real short-term financial pain. BetterHelp revenue came in at $236.9 million. What's the hidden signal in that number that the CFO wanted to highlight?
Well, the most important number within that total, despite being quite small right now, is the insurance revenue component. That $236.9 million included approximately $4 million in insurance revenue.
$4 million?
Yeah, primarily flowing from the Uplift acquisition they completed last year, which was designed to kickstart this capability. That $4 million, even though it's tiny compared to the overall segment revenue, it is the future, or at least the hoped-for future. It signals that the very early stages of the insurance rollout, which the CFO mentioned, is now live in 7 states plus D.C., following that initial Virginia pilot, are actually working and generating some initial revenue.
So, okay, $4 million is almost negligible compared to $237 million overall for the segment, but it represents the first tangible, measurable proof point that this massive, complex transition toward insurance coverage is possible, at least technically.
Exactly. It's a foundational number, a starting point.
Yeah.
But yeah, the vast bulk of that $237 million in revenue is still coming from the traditional direct-to-consumer, or DTC, cash pay model. And that model, as the CFO acknowledged, is under tremendous pressure right now.
What did the user metrics reveal about those sustained challenges in the cash pay business? What did the CFO share there?
The key metric here is average paying users. That declined 4% year over year to 382,000.
Down 4% to 382,000 users.
Yeah. And digging deeper into that, the problem seems entirely localized to their most important market, the U.S. The CFO indicated this overall decline was driven by a high single-digit decline in U.S. users.
High single digits down in the U.S. Ouch.
Yeah, and that was only partially masked or offset by continued high single-digit growth in non-U.S. users. So international is still growing, but the core U.S. cash pay market is definitely shrinking right now.
A high single-digit decline in the core U.S. cash pay market is, well, it's brutal. What are the key drivers the CFO identified for that user exodus?
The CFO cited sort of two main things: persistent weakness in overall consumer sentiment and the general macroeconomic uncertainty that continued right through the third quarter. Basically, consumers are tightening their belts.
Right.
And discretionary cash spending, especially on things like mental health services when maybe there are cheaper or covered alternatives, is often one of the first things to get cut or shifted.
But the structural issue goes deeper than just the macro environment, doesn't it? It's the strategic dilemma facing the entire company, which the CFO seemed to acknowledge.
It is. It's this fascinating dilemma of disruption, almost self-disruption in a way. What's happening, and this CFO alluded to this, is that the growing willingness and ability of consumers to access mental health therapy through covered benefits, through their insurance, acts as a massive headwind to BetterHelp's traditional cash pay business.
So people are realizing they might not have to pay full price out of pocket if their employer's plan or their marketplace plan covers therapy now.
Exactly. The market itself is accelerating the need for BetterHelp's pivot. It's essentially eating the company's current primary revenue stream while simultaneously validating the new direction they're trying so hard to move into. It's the definition of intentional short-term damage for hoped-for long-term gain.
It's a classic high-wire act, as you said before. They have to acknowledge the pain it's causing now, but they see the shift toward insurance as really the only viable path to long-term sustainable growth for the BetterHelp brand and platform.
That's the narrative, yes. Long-term necessity versus short-term financial pain.
Okay, let's analyze that immediate financial pain then. The impact on BetterHelp's profitability in Q3.
Yeah, this is definitely the weakest point financially right now. Adjusted EBITDA was extremely low, just $4 million for the entire segment.
Only $4 million on nearly $240 million of revenue.
Exactly. That resulted in a paper-thin 1.6% margin for the segment. Now, compare that to the 17% margin we just talked about in integrated care. You see the dramatic difference in profitability profiles between the two segments right now.
Wow, 1.6% versus 17%. What caused that margin to erode so much year over year?
According to the CFO, the decline was directly driven by two main factors. First, just the lower revenue flow-through resulting from that DTC decline we discussed. Less revenue means less profit, obviously. And second, the necessary accelerated investments required to actually execute this huge insurance rollout.
What do those accelerated investments entail specifically? What costs are we talking about?
These are major operational expenditures they have to incur now to build the foundation. We're talking about massive investments in credentialing thousands upon thousands of therapists across potentially dozens of states to meet all the different insurance network requirements.
That sounds incredibly complex and expensive.
It is. Plus, technology enhancements for handling complex insurance claims processing, eligibility checks, billing integration, and then just the general operational expense of launching and marketing a completely new B2B product line aimed at payers and employers. Now, the CFO did mention they mitigated some of this pressure because they had lower advertising spend in Q3 compared to previous periods.
Right, pulling back on the DTC marketing.
Yeah, but clearly, the strategic investment costs needed for the insurance pivot far outweighed those advertising savings in the quarter.
So that 1.6% margin, it's really not indicative of a mature business operation. It's the margin profile of a segment that's essentially in full-on development and transition mode.
That's precisely it. Management is, by necessity, deliberately absorbing this short-term margin pressure to try and ensure the long-term viability and scalability of the insurance model for BetterHelp.
Okay, makes sense in context. Let's move on to how this all rolls up into the guidance.
All right, let's synthesize these segment dynamics now into the updated expectations for the full year 2025, as laid out by the CFO, starting with the consolidated view. Despite all that volatility we just discussed in BetterHelp, the overall financial picture for the full year actually remained quite stable, at least at the midpoint of the guidance ranges.
That stability must be almost entirely thanks to the outperformance and resilience of the integrated care segment offsetting the BetterHelp weakness, correct?
Precisely. That's the story in the numbers. They maintained the range for the critical consolidated figures. Full-year revenue guidance was narrowed slightly, but remained firmly centered, now projected between $2.510 billion and $2.539 billion.
Okay, midpoint basically unchanged.
Exactly. And adjusted EBITDA guidance also remained consistent overall, expected between $270 million and $287 million for the full year. The strength and margin performance of IC is effectively compensating for the revenue and margin drag from BH right now.
And what about the cash flow expectations for the full year? Did that hold steady too?
Actually, they raised their outlook slightly here, which reinforces that power of the cost discipline we talked about earlier. Full-year free cash flow is now expected in the strong range of $170 million to $185 million.
$170 to $185 million in FCF for the year. That's a significant marker of true cash generation and internal operational health, even with all the moving parts.
It really is. It shows the underlying business, ex-BetterHelp's transition costs, is throwing off significant cash.
There was also a notable internal adjustment the CFO mentioned regarding stock-based compensation, or SBC, expense for the full year.
Yes, and this, I think, demonstrates management's agility in controlling even non-cash expenses when needed. The full-year stock-based compensation expense forecast was lowered by $10 million compared to their prior guidance. It's now projected at $85 million to $95 million for the full year.
Okay, a $10 million reduction in expected stock comp. Now, we should probably challenge the narrative here a bit. The CFO confirmed that this $10 million reduction in SBC is expected to largely offset that surprise 7-cent per share goodwill impairment that hit in Q3, helping to keep the full-year net loss per share guidance range intact. Is this a genuine operational offset, or is it more like clever financial reporting to minimize the shock from the impairment on the headline net loss number?
Yeah, that's a fair question. It's probably a bit of both, but leaning more toward the latter in terms of true operational equivalence. They are effectively offsetting a write-down of, let's call it, a historical financial decision, the goodwill from a past acquisition with a reduction in a future operational expense, saving the lower stock comp. While both are non-cash, and yes, they both impact the GAAP net loss figure, they aren't really apples to apples in terms of cash flow impact or direct operations today.
Right.
The SBC reduction is genuine savings, though. It shows improved discipline in managing compensation costs, which is positive. But using it to perfectly offset the goodwill loss feels primarily like a mechanism to stabilize the reported full-year net loss per share range for investors after the Q3 surprise. The good news hidden in there, though, is that they are finding ways to pull $10 million in sustainable savings out of the model.
Understood. Okay, let's focus now on the segment-specific guidance updates the CFO provided, starting with the good news for integrated care.
Right. Integrated care guidance wasn't just maintained, it was actually raised and narrowed upwards. Full-year revenue guidance for IC increased by about 40 basis points at the midpoint. It's now expected to be up 2.4% to 3.5% over 2024. That signals increased confidence in their B2B performance for the rest of the year.
What specifically drove that upward revision in IC revenue guidance?
According to the CFO, roughly half of that increase relates directly to the inclusion of the Teladoc acquisition in Australia, again highlighting M&A as a powerful, predictable growth lever for them right now. The rest of the increase reflects the strong year-to-date execution we saw in Q3, particularly those increasing utilization rates within their member base. And Catapult, the other recent acquisition, is still expected to contribute about 200 basis points or 2% to IC's full-year growth. So acquisitions are clearly pulling significant weight here.
And critically, the IC profitability outlook improved as well.
Yes, it did. The full-year adjusted EBITDA margin guidance for IC was raised by 30 basis points at the midpoint. It's now expected to land between 15.0% and 15.4% for the full year.
So that increased margin expectation confirms that the cost discipline we saw in Q3 is expected to be sticky and sustainable right through Q4, even though they might be facing some external pressures.
It absolutely suggests that. And interestingly, the CFO noted they're maintaining their estimate of a roughly $3 million headwind to adjusted EBITDA for the year due to the ongoing tariff situation, some kind of persistent external cost they can't control. But even factoring in that $3 million hit, the operational efficiencies they've achieved internally, particularly in G&A and tech dev spending, are apparently strong enough to justify raising the overall margin guidance for IC. Very disciplined execution there.
Okay, that's the good news from IC. Now for the more cautious outlook on BetterHelp. The pressure here is pretty evident in the updated guidance the CFO delivered.
Yes, definitely. BetterHelp's full-year guidance was narrowed, specifically to the lower half of the prior range they had given. The expected year-over-year revenue decline for BH is now forecast between 8% and 9.2%.
8 and 9% decline for the full year.
Yeah. That firmly reflects those persistent headwinds in the U.S. cash pay business that we discussed. This is basically management acknowledging the short-term top-line impact of this market transition is real and ongoing.
But what is the revised expectation for the future, that crucial insurance revenue for the full year 2025? Did the CFO update that target?
Yes, and that is the silver lining they really want investors to focus on. Based on those successful early-stage launches, BetterHelp now expects to generate between $12 million and $14 million in total insurance revenue in 2025.
12 to 14 million for the year.
Exactly. So that gives us a concrete, measurable target for the success of this pivot, at least in its inaugural year. Something tangible to track.
Okay. And how did the combination of lower overall revenue expectations for BH and those accelerated investments impact the full-year margin guidance for the segment?
As you'd expect, it pushed it down. The full-year adjusted EBITDA margin guidance for BetterHelp was reduced by about 55 basis points at the midpoint. It's now expected to land somewhere between 3.8% and 4.6%.
3.8 to 4.6% margin for the year.
Yeah. And that reduction is purely strategic, according to the CFO. It reflects One, the flow-through impact from the lower revenue base, combined with, two, the absolute necessity of making those accelerated investments now in credentialing and technology to ensure the insurance initiative is actually ready to scale rapidly, hopefully starting in 2026.
Got it. So to truly understand this full year guidance, we really need to analyze the implied fourth quarter expectations that underpin these targets. What does management need to deliver in Q4 to hit these updated full year figures?
That's the key. Let's break down the implied Q4. For integrated care, Q4 segment revenue is expected to increase somewhere between 1% and 5.2% year over year. That's solid kind of standard growth for IC these days. But more dramatically, the adjusted EBITDA margin for IC in Q4 is expected to surge. The guidance implies a Q4 margin between 15.3% and 16.8%.
16.8 at the high end for Q4 IC margin.
Yeah. And crucially, at the midpoint, this represents a significant 250 basis point year-over-year increase in margin compared to Q4 last year. That enormous jump is expected to be a direct result of their tight cost discipline, finally meeting the expected higher flow-through from increased utilization, which typically happens during the end-of-year benefits period as people use up deductibles.
Wow. So that implied Q4 integrated care margin performance is essentially what makes the whole consolidated EBITDA guidance for the year achievable despite BetterHelp's struggles.
It really seems to be the linchpin, yes.
Okay, what about BetterHelp's implied Q4 expectations? Does the guidance imply the margin stays near zero like it was in Q3?
No, actually, the margin for BetterHelp is expected to sequentially improve quite a bit in Q4 compared to Q3. BetterHelp's segment revenue is still expected to continue its year-over-year decline in Q4. The guidance implies a drop somewhere between 3.8% and 8.8%. However, the adjusted EBITDA margin for BH is expected to sequentially improve from that weak 1.6% in Q3, landing somewhere between 5.5% and 8.6% in Q4.
Okay, why the sequential margin bounce back for BetterHelp in Q4, even with revenue still declining year over year?
This is apparently a typical seasonal phenomenon for direct-to-consumer businesses like BetterHelp. The CFO explained that BetterHelp traditionally pulls back significantly on advertising and user acquisition spending during the fourth quarter, particularly during the heavily competitive holiday period.
Lower ad spend in Q4.
Exactly. Lower advertising spend directly translates into higher, albeit perhaps temporary, sequential margin improvement. It doesn't necessarily mean the underlying business dynamics have structurally changed yet for BH. It just means they're planning to spend less on marketing in November and December.
Got it. Seasonal ad pullback lifts the Q4 margin temporarily. Makes sense.
Okay, let's just finalize our view with the company's capital structure and its strategic capacity based on the CFO's closing remarks. The balance sheet isn't just strong. It provides the company with enormous leverage. Not debt leverage, but strategic leverage.
They made a key acquisition in the quarter using cash, reinforcing that M&A strategy, particularly for integrated care.
That's right. The CFO noted they used a disciplined $17 million in net cash for the Teladoc acquisition in Australia back in August. This relatively small, cash-funded acquisition seems perfectly aligned with their stated priority of expanding high-margin international services within the IC segment. Bolt-on, not transformative.
And let's just reiterate that final cash position because it really dictates their future maneuvering room.
Yeah, the CFO hammered this home. The balance sheet remains undeniably liquid. We noted earlier the $726 million in cash and equivalents sitting there at the end of Q3. That figures the core stabilizing factor for the entire investment thesis right now. Furthermore, their leverage position is exceptionally healthy. The CFO stated net debt to trailing 12 months adjusted EBITDA is under 1 time.
Under 1-time leverage. That means they have barely any net debt relative to their operational earnings power. That really puts them in the financial elite among many digital health companies, a lot of which carry pretty significant debt burdens from past growth spurts.
Absolutely. This very low leverage, coupled with the strong ongoing cash generation, remember that expected $170 million to $185 million in FCF for the full year means they have minimal near-term financial risk.
So what does that optionality the CFO mentioned specifically translate to in real terms for you, the listener? What can they do with that strength?
Well, it means flexibility on several important fronts. They can comfortably manage their significant 2027 convertible debt maturity without stress. They could pay it off with cash if they wanted to. They can pursue further strategic targeted M&A like Teladoc and Catapult without needing to tap expensive external financing. And theoretically, they have the dry powder to potentially initiate a share repurchase program down the road if they feel the stock valuation warrants it, although the CFO didn't explicitly state that intention in these remarks. The bottom line is the financial foundation is rock solid. It allows this complex, risky BetterHelp transition to proceed without the added pressure of a liquidity crisis hanging over them.
Oh, yeah.
Hashtag tag outro.
So wrapping this all up, what does this financial synthesis from the CFO mean for you, the learner? It really paints a picture of a company in the midst of a massive and somewhat painful strategic transition. It's a tale of two very different segments right now.
Exactly. Integrated care is functioning as the stabilizing force. It's efficiently driving margin expansion through those targeted acquisitions and, crucially, relentless internal cost management demonstrated by that huge implied Q4 margin bump the guidance points to.
Meanwhile, BetterHelp is the calculated risk. The financials show it is intentionally absorbing significant short-term pain, the revenue decline, the margin compression to facilitate what management clearly sees as a non-negotiable long-term pivot toward the insurance-covered mental health market. The core theme seems to be using disciplined operational improvement in the stable IC segment to fund the strategic disruption required in the volatile BH segment.
Yeah, and maybe the most fascinating component of this entire financial synthesis, at least from the CFO's perspective in Q3, is that intense focus on operational excellence, particularly those internal cost controls that were highlighted repeatedly.
It really felt like the defining feature this quarter.
It did. Remember that $10 million reduction in stock-based compensation expense forecast and how it was positioned to largely offset the Q3 goodwill impairment? Management is clearly demonstrating an ability, or at least a strong focus, on extracting efficiency even while they're investing heavily elsewhere.
Which leads to a final provocative thought.
Exactly. This raises an important question for you, the listener, to consider as you watch this unfold. Given the company's incredibly strong cash position and this newly emphasized, disciplined approach to cost structures reflected in those improving G&A and tech dev metrics, how long can this operational efficiency alone sustain the consolidated margin improvements? How long can IC's efficiency carry the load before the BetterHelp insurance rollout reaches the critical mass needed to drive structural revenue and profit growth for that segment? Is this intense focus on cost control merely a temporary bridge to get them through the transition, or does it represent a fundamental permanent change in the company's culture? Could that discipline become their secret weapon for navigating the next phase of potentially volatile, growth-dependent expansion?
A perfect question to mull over as we watch the progress of that BetterHelp insurance revenue target, that $12 to $14 million for this year. That's it for this deep dive into Teladoc Health's Q3 2025 financial synthesis from the CFO. We'll catch you next time.